Hi, I'm Harry, head mentor at AiXiom, and today I'm going to talk about government macroeconomic intervention. This unit basically covers four parts. So first is the objective of government and then three corresponding policy to achieve these aims, which is fiscal policy, monetary policy, and supply side policy. Now, so before actually talking about the syllabus or the content point, I would first want to explain how you would like to answer a SOA question in CIE. So the structure is as follows. So basically you state precisely the policy or the definition of the thing you want to discuss, and then you discuss the mechanism like drawing graph and explain it by words. And finally, the evaluation, which is like talk about strengths, weakness, and potential limitations. Now, coming to the real policy objectives, and in the AS level, it is basically divided into three parts, which is price stability, low unemployment, and economic growth. There are also other relevant aims, which is like stable balance of payments or sustainability, etc., etc. But in AS level, we mainly focus on these three aims. And I think another point was to mention here is that we are essentially talking about two entities, which is central bank and like the government or treasury. So for the central bank, they only have two mandate or two objective to focus on, which is price stability and low employment. This is central bank, which have price stability as the primary aim. And for government, they care about all these objectives and prioritizing different based on the context. And I think one more thing to mention about here is that economic growth, government wants an ideal sustained rise and stable economic growth, which is that it's not the higher the growth rate, the better, because if you have a super high growth rate, then it typically means you are also having some overheated economy and inflation problems. So as an ideal environment, the government want a stable and low inflation with a maximum employment and a stable economic growth. And here is the analytical framework that we are going to use when talking about policy, which is ADAS model. We have the aggregate demand, the short-run AS, and the long-run AS. And of course, we will talk about this analytical framework in a separate lesson, more detailed. But just to mention here that the difference between short-run AS and long-run AS is whether price or factors are fully adjustable. Let me also turn on the do not disturb mode. And so this basically means in the short run AS, some factors price are fixed. This means that if you have a higher price, this encourage firms to produce more because there is a profit motive. But in the long run AS, all price and factors are fully adjustable and flexible, so you will be producing at the long run potential point. And now just let's jump straight into the fiscal policy. So first is the definition. So fiscal policy is basically two levers, spending and taxation. And it is used to influence aggregate demand, as we have seen just in this graph. So it will lead to, for example, a shift in the AD curve. And because like treasury or government they collect tax and then use the money to spend. So we have this budget deficit and surplus depends on whether you collected more or spend more. And so yeah, deficit situation which is basically you spend more than you collected, and surplus is basically you tax more than you spend. And here is also a few definitions you need to know, and budget and deficit and surplus, we just talk about it. And because like you can't spend the money out of nowhere, you either need to collect it. So for government spending, you have government spending, you have a few sources, right? You can spend by collecting tax, you can borrow, or you can simply ask the central bank to print money, or we call it like inflation tax. So normally the government will not ask central bank to print money, and central bank by institution is separated by political influence. So this is to avoid this kind of situation of government asking central bank to print more money and overblown the whole economy. So normally it will either be tax and borrow, and that's why we have this national debt, which is debt borrowed by the government, by the country. And then a few definition or classification about taxation. So first we have the direct and indirect. So direct tax basically directly tax your income or your wealth, and indirect tax your consumption, which is like tax your income in an indirect way. So that's why they're called direct and indirect. And then we have the classification of progressive, regressive, and proportional, and that is classified based on how the tax rate changes as your income increase. And progressive is basically your tax rate. So the percentage of income being taxed increase as your income increase, and regressive is vice versa, and the proportional is the same percentage point. And then we have the marginal and average rate. So the marginal rate is like tax on the next dollar earned, and average rate is total tax divided by total income, which is a similar concept that you will encounter in all economics, no matter micro, macro. And then we came to the reasons for taxation. So the main reason is basically to raise revenue, because as a government, you need to like fund public goods, you need to provide merit goods, you need to provide all these services, and also transfer payment, unemployment benefits, etc., etc. And that's why you need a lot of money to spend. And also tax can act as a policy to change the aggregate demand. It is a fiscal policy lever, right? It can expand or cool the economy, and that's like based on the context, you can adjust the tax rate and achieve your aim. And also it can act as a redistribution of income. For example, progressive tax like a higher percentage of income for rich people, and then you can use the tax to then fund the transfer payment for the poor, and it acts as a policy tool to make the society more equalized and more equitable. And also you can use tax to correct market failure. For example, indirect tax on like demerit good, to reduce these consumptions that have a negative externality, or that people are just not aware due to information failure. And then we have this Laffer curve, which is a theoretical curve that says tax rate and tax revenue has this bell-shaped relationship. I believe this is beyond the syllabus, but I think a very important implication here is that this relationship means that a very high rates can uh, reduce the incentive to work, invest, and declare income. And so this means that as a government, it's not the higher rate you charge, the more tax revenue you will collect. And so I think this is definitely one thing you can talk about in the evaluation point and as a limitation of the tax policy. And now we came to the government spending. First, also a few definition or classification, which is capital spending. So this investment in long-lived assets, roads, schools, in all these infrastructure that the society needs. And also current spending, which is day-to-day running costs, like public sector wages, medicine, school supplies, etc., etc. And then you have these transfer payments, which is employment benefits and these welfare to the society. And also, this is the capital spending and current spending is classified as exhaustive spending. So basically, what does it mean is exhaustive spending use resources. Therefore, it is included in GDP. And transfer payments, which is like just giving without any production or resources used, is not counted in the GDP. Only after like the people who receive the transfer payment consumes other things, it is included in the GDP. And reasons for government spending, which is basically kind of what we just said as taxes, but yeah, so it basically provide public goods, merit goods, and also redistribute income, manage AD, and also investment in this infrastructure and to increase the productivity of the society and economy. So now we turn to like the classification of the fiscal policy, which is expansionary and contractionary. And it is very simple. So expansionary basically aims to increase the aggregate demand. And then we have contractionary policy, which aims to reduce the aggregate demand. Sorry for the not looking good graph, but yeah, it just illustrates what it means. So expansionary, basically you raise government consumption, government spending, and also or taxes, then you will increase the whole demand and economy. And contractionary is just the vice versa. And also this is a very good graph to show what expansionary and contractionary is. And this is definitely the graph you need to remember to draw in your exam, and this will earn you like the analyzing mechanism marks. Now turning to the automatic stabilizer, which is a kind of unique feature of fiscal policy, which is that in the boom, because people have higher income and you spend more, so you will automatically be taxed more either through direct taxes and through indirect taxes. So the aggregate demand is constrained in a certain way automatically, and then in a like recession, tax revenue falls, and the benefit, like the welfare government need to spend, also increase, and the disposable income and the AD are supported automatically. So this is kind of a unique feature that fiscal policy has. But also one like evaluation you could have is that due to this phenomenon in the recession, like government will automatically be entering a budget deficit. But given that government is already spending more, when the economy recovers, is it politically realistic for government to increase the tax or to reduce spending? So this is kind of some evaluation point you could think about more and you can discuss in the exam. And now moving on to the evaluation, which is one of the most like headache points for most students in the exam. But for fiscal policy, we have a few points to talk about, right? And so the strength is that it is direct and targeted, so it can aim spending at specific groups and specific regions and specific goods. So, and it's another strength is it also works very effective when like your monetary policy is constrained, and also like uh, your economy is in a recession, so you need to use the fiscal policy, and it will be quite effective. And then you have the limitation, which is time lag. So the budgets are decided annual or quarter or half annually, and then you also to passing through a bill or passing through an act, you will need all these like negotiations, meetings, etc. Political process, which can lead to some time lags, and also crowding out, which is that government borrowing can push up interest rate, which then crowd out the private investment. And then we have the debt and credibility issue, which is that government, if it already have large unfunded deficits, then can they continue borrowing without making the market worry about its credibility to repay its debt? Certainly not. Even the most developed countries, like United Kingdom, has faced this 2022 mini budget issue that pushed up the gilt yields. So this is one limitation and one major limitation of fiscal policy. And now talking to some evaluation point that even if we have the fiscal policy implemented, why it may not work. So we have the disincentive and cost push factor, which is that higher taxes may cause like the workers to negotiate higher wages, and then this leads to higher cost and cost push inflation. And also this all depends on expectation, right? It depends on expectation of household and firms for the near future. If they believe the near future is gonna suck, it's gonna still sucks. And so they will still save for precautionary issues, and so AD will barely rise. And it also depends on output gap, right? So if you are already near full capacity, expansion mainly just rise the price level, not the output. Therefore, it is more powerful in a recession rather than when the economy is already operating at full capacity. And now we turn to a case study, which is just the like UK mini budget thing I just mentioned. I'm not going to talk about it in detail here, but worth doing more research if you are interested.